Now the topic before us is from red to black, redefining the color of your balance of payments with actionable strategies. In other words, it means how can a country improve its balance of payments position over the long term. First of all, the question arises, what is balance of payments? Balance of payments is a systematic record of all the economic transactions which take place between the residents of a country and the rest of the world during a specified period. A country may export certain goods and services to rest of the world and may also import other goods and services for its use. A country may send one-time transfer, such as it may give aid, donations or gift to other countries, or it may receive also at other times. Sometimes a country gives loans to other countries, at other times the residents of a country may avail the loan from the abroad. Sometimes investors from our country make investments abroad, and sometimes foreign investors make investment in our country. So these are all economic transactions in which either foreign exchange goes out of the country or foreign exchange comes into our country. So balance of payment is a record which takes note of all these economic transactions. As already told, that balance of payments is just like this, where on one side we have debit entries and on the other side we have credit entries. All the outflows of foreign exchange, all the transactions which result into outflows of forex, foreign exchange, are recorded on the left hand side, and all the activities on account of which inflows of foreign exchange occurs are recorded on the credit side. When we are talking about the balance of payments position, how to improve the same, it means that either outflow is more than inflows, that is, we are receiving less foreign exchange and more foreign exchange is going outside. Improving balance of payment does not necessarily means that the balance of payments position has to be balanced, that is, credit should be equal to debit or credit should be more than debit, that is, balance of payments position should be either balanced or it should be surplus. This is the balanced balance of payment. This is when credit is more than debit, that is, inflow is more than outflow, it means that there is surplus balance of payment. When we are talking about the improving balance of payment, it does not necessarily means that balance of position payment has to be either balanced or surplus. Rather, improving balance of payment means that if there is any imbalance, it has to be within a certain range, within a manageable range. It should not be excessive. If there is any deficit in the balance of payments, then it should not be excess. That is, it is not that key outflows are exceed quite in large numbers than the inflows. For example, we may say that, say in the previous year, our country received 1000 crore rupees as inflows, as inflows. On the other hand, the outflow was only 90 crores. It may be also quite possible that in the previous year, inflow was 1000 crore and outflow was say 90 crore. That is, overall, either the balance of payment was either stable, neutral, balanced, or we were receiving more inflow of foreign exchange. But when we are talking about the improving the balance of payment position, it means that it should not happen that in the previous year there was normal or may not have been normal, but it does not mean that it should be abnormal balance of payment position. That is, it should not happen that our outflows are, we are taking just example, or our outflows are 2000 crore and our inflows are only 90 crores. That is, there should not be abnormal difference in debit and credit side. That is, it is not that there should be huge gap in inflow and outflow. Improving balance of payment means we have to take steps to keep the difference between inflow and outflow to the manageable level. There should not be abnormal increase, or outflow should be at a quite higher level. How? What steps which can be taken by our country to improve the balance of payment position? What steps we can take, our country can take? First is enhancing exports. These are some of the steps which can be taken: enhancing exports, reducing imports, attracting foreign direct investment, managing debt and financial flows, the long-term structural reforms. Now we will discuss each of these one by one. First is enhancing exports. To enhance exports, what steps can be taken? First is that we can reduce export duty. Export duty to be reduced, or we can give incentives to exporters. It may be in the form of cash or in the form of certain other methods. Or not only reducing cash export duty, we can also give rebates in income tax to exporters, or we can also give some sort of rebates in some local taxes which we impose normally. And in the case of exporters, we may give certain rebates in case of domestic taxes. We can also, we should also make investment in research and development and technology, so that we are in a position to produce quality goods and services, and they have good recognition in the export market, and so that our exports increase. To enhance exports, we can also find some more countries where we can send our goods and services. That is where we can export our goods and services. And we can also find out those goods and services which we can export. In addition to the goods and services which we are exporting, we have to find out more goods and services which we can export or which have demand in the foreign countries. Next is to improve the balance of payment position, that is to attract more foreign investment, to have foreign exchange, to get more foreign exchange from the rest of the world. We should reduce imports. How it is possible? To reduce imports, we can increase the import duties. Then what we can do, we can find out import substitution. That is, we are to find out the substitution items for the goods which we are importing, and then we have to raise awareness about these import substituted goods, that so that the residents of the country should use these substitution products in place of imported goods. Next, we can fix the limit of imports of goods and services during a particular period. This is the maximum limit which can be imported. Next is attracting foreign direct investment. We should take steps to attract foreign direct investment. We can offer attractive tax incentives to attract foreign investors so that they make investment in our country. If our tax incentives are attractive, then the foreign investors will bring in the foreign investment in our country. That is, the foreign exchange will flow into our country. Then government of the country should implement sound fiscal and monetary policies. What are those? Prudent management of government spending and taxes. That is, it should have a proper management of the government spending. That is, it should look where it should spend money and what type of taxes should be imposed, or what are those taxes which should be reduced, so that there is favorable atmosphere in the whole of the economy. Then the government of the country can implement suitable monetary policies with regard to money supply and interest rates. These steps of money supply related issues are taken by the central bank or monetary authority of the country. Then the government can also take steps to ensure that there is proper supervision of financial system, so that any financial crisis may not arise. Further, we should take steps, or we should encourage domestic savings, so that our reliance on foreign investment is reduced. Next is long-term structural reforms. It sometimes happens that if in a country there are lot of bureaucratic hurdles, the investors do not come forward to make investment in those countries. So bureaucratic hurdles should be reduced. Ease of doing business should be there. Steps should be taken by the country to address those political and social issues which discourage the investment in the country. Further, we should make investment in education and infrastructure, so that a skilled labor or skilled manpower is there, so that we can take advantage of the same. Then we should take steps that normally it happens that in any country big industries or big houses are in a position to avail loan very easily. Small businesses or the MSME sector, that is the medium level people or middle level businessmen or middle level manufacturers, are not in a position, small scale industries are not in a position to get or avail loan from the financial institutions easily. So the government of the country should take steps that MSME sector easily gets the facility of finance so that they can produce goods and services. And when they produce goods and services, then it will automatically improve our exports, increase in exports and reduction in exports. So in this way, by taking all these steps, we can improve our balance of payments position. That is, we will not have to rely on foreign exchange more. When the import of the country is less, we take steps to improve our exports and take steps to reduce imports, and taking other steps such as physical and monetary steps, then we can surely improve our balance of payments position. Improving the balance of payments position is a complex and ongoing process. It is not that we have taken steps and we take rest. No, it is a continuous process, ongoing process that requires combination of sound economic policies, structural reforms, and long-term vision. And on account of these only, we can achieve sustainable economic growth and development. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.